Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So I'm going to break my chart out into what you're looking at right now is a 5-minute chart of the same thing we were just looking at. This is the Euro USD. If you wanted to pull this up as an index, the index that the FX options are on, this would be equivalent to the EUU. So you could pull that up, and that would be the index that the FX options based on the Euro USD are tracking to. It's going to look very similar to the chart that I'm looking at here. It's going to have a few more gaps, but fundamentally it's pretty much the same. So here with the Euro USD on the 5-minute chart, you can see basically the close of market yesterday. Now the times along the bottom, these are my time zones, so this will vary based on where you are. But this is fairly late in the afternoon in my time zone, and basically at this point the euro was trading for about let's just mark this off so we know where we are, about $1.20. 28.50. That was about right there on my chart. So at this point, I already know that yesterday already the market has broken out on a fairly solid momentum. So it's looking really interesting. So I've already got a bit of a bias established to the upside. Now, the particulars of how I set up the trade or how I thought about my analysis really doesn't matter a whole lot as I use this as a case analysis, because I'm going to go into an actual setup that I'd be looking at today here in just a minute, and I'll explain how I would look at that. But the principles are the same regardless of how you viewed the market yesterday, or if you're watching this recording a month from now. The principles are exactly the same, and I'll show you what I mean here in just a minute. So the idea is that, perhaps we suggest that, before I quit work for the day, I know that this important announcement is coming out, and I'm going to put a limit order in that will, or a conditional order that will get me long the market if it pops up by 50 pips. Okay, so let's say that if the market goes up by 50 pips or so to 1.29, which when you look out in these 4 decimal places, the 4th decimal place here, if that moves up by 1 digit, that's a pip. So if it goes if it goes from $1.2850 per euro to $1.29 even per euro, then I want to go long at that point. So it's pretty straightforward. And by the way, if you're looking at the index, EUU, which the options are based on, the only difference is you'll see the decimal place will be moved over 2 places to the right. So it'll be 128.5 at the same time. So in the middle of the night tonight, we hit 29.50, or I'm sorry, 29 even, 1.29 even right here. Now, this is where things become problematic, and this is where Forex traders are beating their heads against the wall. They've entered the order to trigger at 129, and they probably, as part of that order setup, since they may or may not be in front of their trading station at the time this particular event takes off, they're probably going to bracket it. So what I mean by that, and this is common, and I see traders do this in all kinds of markets, including the options market, they'll simultaneously enter orders that will accompany this one for, well, if the market goes up a whole lot, I want to get taken out and take my profits off the table. Or more likely, I'm going to include a stop loss on this order. So let's say in this case that I included a stop loss for 50 pips worth. If you were trading mini lots, so that's a very common position size, and it's roughly the equivalent of an at-the-money call option. It's going to behave very similarly. That would mean that I would lose $50 per lot. So if I were trading 10 mini lots, I'm going to lose $500 if I get stopped out, which, of course, I don't have to tell you. You can see for yourself. I would have been stopped out in the early morning hours. This is the problem. Now, was my analysis wrong? No. In fact, it was right. The market, if I'd bought I'd entered an order to buy, and ultimately the analysis was correct, and the market began going up. But these whipsaws in the currency market before a news announcement or during a news announcement are extremely common, and they're very expensive. Because all we have to do is ask ourselves, how much did this particular trade cost us? Well, If I lost 50 pips, then it cost me $50 per lot. So if I were trading 5 lots, as I said before, then that's $250 I lost, or 10 lots, it's $500 I lost. And why did I include a stop? Because what if things break out to the downside? I could start accumulating very large losses very fast. If the Forex really breaks out, and if an FX pair really breaks out and starts moving very, very quickly, those losses can accumulate very fast. So if you are attending this, and I know from prior conversations that we have a pretty good mix of those of you out there who have been trading options and are looking at FX options, and those of you who have been trading Forex and are now looking at FX options as a way to protect your risk and take advantage of opportunities that may be more suited for an option contract versus an outright spot position. So I find that if you're a Forex trader, this is where the real strength of FX options really shines, because this is exactly how we would do this. So let's say that rather than buying or entering a conditional order back here at the end of the market or the end of the day yesterday, instead of doing that, I bought a call option. Now we all know expiration's coming up on Friday, so I could buy a call option that's only good for another couple of days, and that's okay because I'm trading the news, and the news, it's coming out tomorrow, and the market's either going to take off like crazy or it's going to go down like crazy. But I'm basically betting on volatility, and I would assume that if I'm right and the market goes up because I'm buying this call, then I'm probably going to be really right. So so I would look at it and I would say, well, my risk reward is pretty good. Now, I don't have very many days before expiration, so it keeps the damage I might incur from time value, kind of keeps that under control. And we could do an easy analysis here. So let's say that at the time I decided that I was going to buy a call option instead. So maybe I'll go just barely out of the money. So I would buy to open a September call, because I don't need to hold it through expiration. I probably would get rid of it today if I'm just trading this particular news event. So I already know in advance that this news announcement is due today. So I knew in advance this is going to happen. So the market's either going to move or it's not, and I'm not going to have to wait around for it to find out whether I was right or not. So I'm okay with the short expiration. That's going to keep time value pretty small, and which will mean that I don't have to pay a whole lot to get into this option. And so let's say I buy something that's close to at the money, maybe just one move out of the money or something like that. Well, that I was pricing that this morning, actually yesterday afternoon, and it was trading for, just depending on where you were willing to go with your strike price. We were kind of in the middle of strike prices towards the close of the market, and it was trading for between $50 and $65 per contract for an at the money option at that point. It was expiring on Friday. So now, if you're a Forex trader and you're wondering, well, so one call contract, I understand what calls are, but normally we think about calls relative to equal to 100 shares of stock, let's say. Well, in the Forex, there's a notional, with the FX options, there's a notional value that is underlying on that particular contract, and it's very similar to one mini lot. It'd be like 10,000 units of the base currency. So if you're looking at trying to figure out what the equivalents are, you would think about one at-the-money call option is very similar in notional value to one mini lot, by the way. So if you're an options trader, you probably don't need to worry about any of that, because this is going to work like a regular option. We know that the index was at 128.5 or so, or 120. It was between 129 and 128 at the close of the market. And if it goes up by a couple of bucks, we can translate that into how much in gains are we going to make on this particular call contract. It doesn't have to be any more complicated than that.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.